Good evening, everyone. Burak Bakan here. I am genuinely excited to introduce Ed Clissold to you guys, to you folks this evening. Chief US Strategist at Ned Davis Research. NDR provides meaningful and targeted market analysis for firms like us, investment advisors, so they help us make better informed investment decisions. He is a chartered financial analyst, CFA, and has earned an MBA in finance from Indiana University. He's been with NDR for 22 years. I've been following NDR for God knows how long, so I've been reading his commentaries for years and years and years. So that's why when I said I was genuinely excited, I meant it. We have collected some questions from you. As the time allows, I'll be asking them to Ed, some of whom were not relevant to our topic this evening. So we read those out, but we'll get back to you if your questions are not answered. We can certainly follow up. The big question is why we're all here this evening. As you know, the potential impact of the upcoming US elections, presidential elections on capital markets. Ed will have the floor this evening. Without further ado, take it away, Ed.
Thank you very much, and thank you everyone for coming on this nice evening. I'm sure you could do a lot with your time, so I appreciate you lending us some of yours. And we'll get right to the point. We're going to talk about the markets and the election and how they're intertwined. Well, what we'll do is we'll talk about the way we do things at Ned Davis Research. It's very data oriented, and there's some great political strategists out there who are going to tell you, this or that, Biden wins, Trump wins, this is what I think they're going to do, not do. That's not what we do at NDR. What we do is we take probably what I would say the best historical database in the world, our own proprietary software system that we wrote to analyze the markets, and then we're applying it to elections. So what we're going to do is we're going to talk about how the presidential cycle has impacted the markets and why that has happened. And then we're going to dive into what generally happens around elections with the markets and leadership trends. And then we're going to get into how it really applies to 2024. And because we know what Biden has done in his first term, and we actually know what Trump did in his first term, we can actually look at some things in a way that we really haven't been able to do in modern market history, because this is the first time since 1896 that we have had two presidents who had been in office running against each other on a major ticket. Before you go off to Google and try to figure it out, that was Benjamin Harrison and Grover Cleveland. I'm sure they're on the tip of your tongue of important U.S. presidents. But in 1884, Cleveland won, and then Harrison won in 1888, and then Cleveland won it back in 1892. Yes, for you Roosevelt fans, Teddy Roosevelt did run against Taft in 1912, but that was in the Bull Moose Party. So it was a third party. But at any rate, this is certainly a very unique situation. So we're going to get into that. So you look at history, but you also got to look at some other stuff too to kind of understand where you are. So let's dive into some charts, shall we? Okay. So here what we're doing is we're looking at the Dow over a 4-year presidential cycle. So this is on average what the market has done over 4 years. Side note, we use the Dow because it has more history than the S&P. We get some more cycles in it, because there's not a ton of presidential cycles to use. The trends are the same. The numbers might be slightly different in terms of the exact percentages, but we look at all the S&P too. The trends are the same, and so don't get hung up on Dow S&P. The conclusions are pretty much the same. But what we're showing here is that there tends to be two pretty strong periods of strength for the market in a 4-year cycle, and two periods of weakness. So, starting around the middle of the election year, you get this great rally that carries through the first presidential year. Then you get weakness for the end of the first year into the midterm year, a huge rally up through the third presidential year. And then you get kind of sideways action end of the third year and then into the election year. So we're actually toward the end of one of the weaker periods of the cycle, which we'll get into a little bit why it really didn't work that well this time. We'll get into that. But that's how the pattern works. And the reason for that is that there is a pretty strong pattern in how government policy works. So what we're doing in the bottom section here is we are looking at the 4-year cycle in monetary and fiscal policy combined. So what's the Fed doing, and then what the federal government is doing. So this chart actually starts with the third presidential year because we don't have all the data in yet for 2023. But what you can see it happens is after the election, they take some stimulus out. It really, the bottom falls off in the midterm year. Remember, that's the weakest part of the cycle. And then they start to accelerate it through the pre-election year, and then it kind of continues into the election year. And so there is a tendency for policy to impact the market. So politicians may say, oh, we don't manage the economy to get reelected. But we have, in this case, about 60 years of data to suggest they just might do this. And yes, it's happened under Democrats and Republicans. So they both kind of do it. And then last year, 2023, was this kind of accidental stimulus where the cost of living adjustment for Social Security was the biggest in 40 years. At the same time, which because we didn't have capital gains taxes to be paid, and from 2022, because those are a dismal year in the market, the tax receipts went down. So you had this like massive fiscal stimulus that really wasn't, Biden couldn't get through Congress and whatnot, but it doesn't matter. You still got a stimulus last year. So, so that's the cycle, and that's the reason why the market tends to follow a 4-year cycle, and why we should pay attention to it. Okay, so we'll look at a couple different areas of the market and how that does during presidential cycles as well. Here we're looking at small caps versus large caps. This is Russell 2000 small cap index. Russell 1000 represents large cap stocks. And so when this line is going up, means small caps are outperforming. When it's going down, large caps are outperforming. And so we're kind of walking through the 4-year cycle. As we get into the election year, we're kind of getting to the point when small caps tend to outperform. Because again, when the market starts to rally at this part of the election year, high beta stocks like small caps should outperform. Now, interestingly, though, you get some uncertainty around the election, and you tend to get some defensive stocks working better. So here, what we're doing is we took the sectors and we divided them into what we call cyclical sectors and then defensive or shut sectors. So when this line is going up, the cyclicals are outperforming; it's going down, they're underperforming. And heading into the election, because you start getting some uncertainty, actually some more defensive areas outperform. So you get some cross currents here. And interestingly, this year we've had cyclical strength, and now we're kind of at the point when you'd expect maybe some defensive stocks to do better. Again, this isn't a prediction of price per se, it's just kind of how the pattern has worked. Okay, so now let's talk about what happens depending on how the incumbent party does. So what we're showing here is the Dow just during election years, and this dark blue line is just all election years. And then we looked at, well, what happens if the incumbent party wins or loses a Democrat or Republican? So when the incumbent party wins, the market does better. Incumbent party loses, it tends to do worse. It's exaggerated under Republicans just because you have a few outlier leaders like 1932 and 2008. I wouldn't draw too many conclusions from that. But okay, so this is where it gets into what's going on now. There's 2 periods of weakness within the election year. One is the first part of the election year, and then you get another period of weakness going into the election. So the first part is over who's not going to be the nominee from each party. So in any given year, you have at least one who we don't know. Sometimes it's 2, and there's angst around that. Well, we didn't have that this year, right? It was pretty clear that Biden and Trump were going to be the nominees, barring a health problem or something with the judicial system. So maybe that's part of the reason the market has done well beginning part of this year is we didn't have that nominee uncertainty. As we get closer to the election, you get another pullback, and it's probably going to be a close election whether we like it or not. And so I wouldn't be surprised if we got some uncertainty around that as we move into the summer and fall. But that's generally how it has worked. I want to point out too, sometimes it does become clear who's going to win. Like in '96, it was very clear Clinton was going to get reelected. So there are two small corrections, and then the market really zoomed through the rest of the year. 04, very different. Bush was in a close reelection contest with John Kerry, and the market didn't rally until after the election. They technically bottomed like a couple weeks before, but it really didn't take off until Bush had won a reelection. And so we'll see. Maybe it'll be clear who's going to win early, and the market can get through that. But I think most people expect it to be a pretty tight election. Okay, so after the election, we get a relief rally, and in particular, we're showing here is sector performance. What happens after the election, and so the blue bars are 6 months when they come after the election, when the incumbent party wins, and then the orange ones are when the incumbent party loses. So actually, because there's when the incumbent party loses, the market tends to do poorly. After the election, the market tends to rebound, and the cyclical areas tend to take over. And so there's an important message there overall about the uncertainty, so confusion and angst if the incumbent loses a lot of times, but the market tends to move past it on average pretty quickly. So here's another sector point here, and that is healthcare as a sector has preferred the status quo. And the reason for that, it's a common and popular punching bag for both parties. They like to talk about, big pharma and they've done this and that wrong. And so when the incumbent party has won, in the market sniffs it out, healthcare's done pretty well going into the election. But when the incumbent party has lost, it's like, oh, well, maybe the new person's actually going to do something about healthcare, and they generally don't. So the market rebounds afterwards. And I wonder how much this could apply to big tech now. If maybe big tech has replaced healthcare as a favorite punching bag for the market. So I wouldn't be surprised if both parties take maybe some sharp tongue to the tech sector, and if maybe it follows some of this pattern this cycle. Okay, so now we're moving into what's happening after the election. This is one of our more popular charts because it's really getting at what has happened when you've got a combination of presidents and Congress. Okay, so there's 6 different ways this can go. You can have a Democrat president with Democrat Congress, Republican Congress, or split Congress. House and Senate is different, and the same thing with Republicans. So three with each presidential party. So actually, inflation-adjusted returns have been highest under where we are right now: Democratic president and a split Congress. I think in this case, you don't want to get too caught up in any one stat because this has only happened twice under Obama and Biden. But in general, Democrats have done better when you've had some sort of check on their power. Republicans actually have not. They've done better when you had Republicans in control of Congress. But that's also because what happens sometimes is the market tends to boom under Republicans, and then when it rolls over, Republicans lose Congress first and then the presidency. So that's why you get this Republicans and then some sort of Democrat leadership of the market does poorly. So we look at what's going to happen after the election. If Trump were to win, probably pretty likely he'd have a Republican Congress. If Biden were to win, there's probably still a chance that the Senate would flip, even if maybe the House stays. But regardless, if you look at it, again, this is just history. But if Trump wins or Biden wins, you may actually have a pretty good combination of leadership. But I think what we really want to remember too is that a lot of times, if you look at Trump versus Biden, their domestic economic policies are pretty different. I don't think unless one of them gets a really strong majority, they're going to get a lot of their policy proposals through. It's going to be more tax hikes for Biden, or it could be some tax cuts that Trump's proposed. Probably unlikely either one of them really gets a whole lot done. And so this chart is showing that, again, we're looking at cyclicals versus that defensive shut group of sectors. And actually, when you have a Democrat president, you tend to get more cyclical leadership. That's because, generally speaking, you get more stimulus under Democrats, more government policy trying to kind of boost the economy, and that would favor things like industrials and materials and energy for the most part, versus under Republicans when it's more about cutting taxes. Maybe you don't get that direct stimulus impacting quite as much. Okay. So now let's, we're going to try and transition more to Biden and Trump specifically. We're going to hit a few slides here before we get into some questions from you guys. Okay, so this is, I alluded to at the beginning, this is showing how rare this is. These are all rematches for presidents. So the last time we had this was in 1956 when Eisenhower ran for election and the Democrats basically put Adlai Stevenson up there again because they knew they probably weren't going to win anyway. But and then we have a few more. You can see historically we've had a few more, but a lot of those happened much earlier when the nominees were determined by the parties, in some cases, smoke-filled rooms at conventions rather than through the primary system. And really, as we get the current primary system evolved in the 1960s. And since then, we really haven't had somebody like Trump to certainly win the nomination 3 times, let alone twice. Kind of in 1960, Nixon was the nominee, lost a close election to Kennedy, sat out 64, got the nomination again, which is really more of a true primary in 68, and then went on to win the election. But so Trump, a lot of ways has already made history. He may not view it that way because he wants to win the presidency, but first person to win, the party nomination 3 times through the primary system. But when you think about rematches, again, this hasn't happened very often at all. And again, certainly to previous presidents, hasn't happened since 1892. So we talked a little bit about what Biden would probably like to have happen. And really, the biggest thing is that he'd like to have happen is he would like to have the economy do better. More importantly, he'd like people to feel better about the economy. If you were to look at Biden's approval rating, it actually no president has been reelected with approval rating this low at this point in his presidency. So that's a stat really working against Biden. But if you ask voters what their issue is, it's inflation, it's the economy. So if people feel better about the economy, that would be good for Biden. And also, that's actually how history works. So what we're doing is we're taking the University of Michigan Consumer Confidence Index, and we're looking at it leading up to the election. So here's election day, here's the year before, year after. And when the incumbent party wins, you get a big improvement in consumer confidence. And you have seen that over the last few months. So that's something for Biden to potentially be excited about. But he's probably going to need more of that. People are going to need to feel better about the economy to win. And again, the history suggests that's particularly important under Democrats. So these are some of the issues Biden is facing. These are just some stats for Biden and Trump. In the first 3 years, that's where we are Biden, and the pandemic really wreaked havoc on economic data in Trump's 4th year. So more apples comparison, and in particular, it's high inflation. If you look, it's when you talk about inflation, economists would say, oh, well, inflation's up 3% versus a year ago. It's great, but most people don't think that way. They think, well, in 2019, 2020, this is what I was paying for groceries, this is what I was paying for gas. And so, this is a total inflation for some goods over the first 3 years. So groceries, Biden, 21%, Trump, 2%, vehicles, 22 versus basically flat. And because of inflation, real average hourly earnings actually been lower under Biden. So these are some of the pain points that voters have picked up on. And I find it interesting if you look at taxes and federal spending. It's certainly you've seen higher taxes and more spending under Democrat and Republican, which is kind of traditional what you would expect. But again, some of this has to do with the COVID spending and things like that, but it's still it's still in there. Okay, so now we look at what happened sector wise during Biden and Trump's terms so far. We certainly had more growth leadership under Trump with tech doing better, tech outperforming under both cases, both presidents, but more so under Trump. Same with consumer discretionary doing better. So of course, you keep in mind what happened early in Biden's presidency is that you had this great rebound during the reopening, and a lot of value sectors did well for a while. So actually the best sector so far under Biden actually is the energy sector. So probably most people would not have thought of it. Okay, so as you start thinking about, what could happen under if Biden or Trump were to win, and which sectors outperform, I think this chart's a really good example that the macro a lot of times can matter more than just who's in the White House. There's only so much a president can do, and also sentiment plays a really big role. Sometimes there's anticipation what could happen, and then the market runs up. So what we're showing here in this orange line is the NDR Clean Energy Index. So it's a lot of renewable energy companies and things like that. And look how it's actually done so much. It did so much better under the Trump administration than the Biden administration. And some of this was anticipation, perhaps, of Trump, I'm sorry, of Biden. But then once he got into office, a lot of that stuff didn't come to fruition. And you would think, well, the traditional energy, you'd get the opposite under more open drilling rights, things like that under Trump. But actually, they've done better under. So the important lesson to remember. And I think as we go forward, if Biden were to be reelected, he probably would. You have a chance because these companies have been hit so hard that if there are some more policies put in place, maybe they'd react better to it, and vice versa with Trump and the energy sector. But again, good lesson to remember here. And one of the things too is that Biden had focused a lot on energy, and trying to bring energy prices down. And what he did is he drained the Strategic Petroleum Reserve as a way to do that. And there's been some angst over it. And generally speaking, oil prices have gone down when they've been draining the reserve. That's what this chart is showing. So you have oil prices in the top section, total petroleum reserves, inventories, and then how much it's changed over the last 3 months. And so when it's been draining, energy stocks have done poorly. When they've been adding, energy stocks have done well. And currently, they're adding to it. But it's from historically low levels. And I think the reality of the situation is because the U.S. basically can produce as much oil as it needs. Certainly, it still exports and imports because of refining constraints. But we get most of what we need from North America. That they don't view the Strategic Petroleum Reserve as something critical. The reserve is in the ground in North Dakota and Texas. So I don't think they're going to be really adding that much to the reserve, regardless of who is president. And okay, so not surprisingly, when you have defense spending increasing as a percentage of GDP, aerospace and defense industry tends to do pretty well. So where we are currently, that's something we could look at going forward. Traditionally, under Republicans, you get more defense spending, but Trump is not always adhered to that philosophy. And we'll see where that goes. If Biden were to stay president, then is there more aid to Ukraine, perhaps? But we keep an eye on the defense spending. Could if that picks up, that would no doubt be positive for the aerospace and defense group. Okay, and then finally here on some of this sector work, mega cap tech, we're going to call it. This is our Tech Titans Index, so it's like it's the fan mags. We'll include a couple other ones like Salesforce and Adobe, which we think kind of fit into that group. But they have done well under both presidents. This is a secular trend, and while, as I mentioned earlier, both presidents may talk about the sector and more regulations, the likelihood of that actually coming to fruition with Congress being where it's at, it's pretty unlikely. So I would expect, that at least from the political standpoint, not a whole lot of change. The other things to drive tech, in its performance, earnings growth, and whether AI, it delivers as many people have hoped that it would. But in terms of the political climate, Biden, Trump hasn't really mattered. Okay. So, actually, I know we wanted to, leave time for Q&A, and we're getting on the point where we could ask some questions. I'm happy to stick around. I know we started a couple minutes late. But to kind of give you the conclusion here, again, you tend to have a presidential cycle where you were entering a bullish phase toward the latter half of the election year, particularly once you know who the winner is going to be. So it could have some uncertainty before that comes to fruition. And you tend to get some cyclical leadership after that. Look for small caps potentially to be one of those. You could get, depending on which party wins, you get some sector leadership changes, but we also want to focus, realize that the macro probably matters more than who's in the White House. So with that, why don't we open it up to some Q&A?
Thank you, Ed. Some of the information is really interesting to see how energy outperforms during Biden and tech outperforms during Trump. Is like some of the information you have shared is something that I would not expect to see. So here are some questions that our clients followers have submitted. How does the growing debt affect the markets?
That's a good question. I get that question so much now. And so I think that the first thing I'd say is that the deficit hawks are a dying breed in Washington. It is just not a whole lot of incentive right now from either party to do a whole lot of it. So I wouldn't expect, under either administration, there to be a big change, and we're going to have deficit spending, pretty much as far as the eye can see. Now, the U.S. has benefited from being the world's reserve currency. So we've been able to finance the debt. We've been abusing that privilege for a long time now. At some point, it will be a problem. It has not been one yet, and so I wouldn't expect, particularly if one president or the other would win, like something to become a front burner issue. But what you probably would start seeing is what you call crowding out, where as interest rates rise, and because especially as we don't have foreign countries like China, like Japan, buying, Saudi Arabia, buying as much of our debt, who's going to buy it? Well, households. Well, that means they're not going to be buying other debt or equities. So it's what you're going to see crowding out from other parts of the market through higher interest rates for corporate bonds, lower valuations for equities. That's when you're going to start seeing it. It doesn't have to be an event like you get in an emerging market where suddenly no one will buy their debt. Now, if you look at what are the biggest line items in the federal government, Social Security is one. They have other entitlement programs after that, then defense, and then it's interest on the debt. But that is quickly catching up. Social Security is still 20% and rising, but interest on the debt has gone from 8% to 11% in the next, say, 2-3 years. It'd probably be number 2 just after Social Security, or past defense, past other entitlement programs. So yeah, that it's going to be eating more into the budget. The problem is a lot of these things you really can't hit the Social Security third rail of government policy, and the discretionary part, the rest of the budget just isn't that big. And so that's the challenge. And how are you gonna cut the deficit from here? If we were going to do it, we would have had to do it a long time ago. And then so what could be happening in 10 years is an automatic cut to Social Security spending because the funds are going to run out. So unless the government makes a change to that, that's going to happen. But until then, yeah, more deficits.
Okay. What could be the impact of the markets of a close election where the winner isn't known for an extended period of time?
Yeah, good question. And we could very much get to, we have a few swing states. We've seen that a few times where the votes don't all the votes aren't counted if it's close enough. They have to count absentees and things like that. The market doesn't like uncertainty, and political uncertainty is amongst those things that the market doesn't like. Under 2000, when we had so many There's a long period of time before we knew who was Bush or Gore. We had the dangling chads, and it finally went to the Supreme Court, and then Gore stepped aside. The market declined, I believe it was over 5%. And then there was a relief rally once it became clear that we knew who the winner was going to be. And so I wouldn't be surprised if something like that took place, where the market could pull back under that uncertainty. And then, but once it clears up, then the market can move on. And I just remind everybody that the market has rallied, the market has declined under Democrats and Republicans. And so what the market really wants to know is what the rules of engagement are, and then it can move forward.
This question you already touched on. You can either say you don't have more to add, or maybe elaborate more on, based on the economic and trade policies of each candidate, how do you think asset classes and sectors in the market will be affected by the election, specifically about energy sector and immediate changes potentially with Trump election?
Yeah, so I think if you talk about international economic policy, they're not really that different, are they? As much as Biden talked about, I'm going to change this and that over Trump, he was oddly silent over some of Trump's protectionist economic policies, and he kept a lot of them in place. In some countries like China, he's been even more of a hawk. And so I don't expect to see a big change, for better or worse, under either one of them. And so the reshoring and manufacturing is going to be there. So they're going to bring up the energy sector. There's going to be demand for energy products to rebuild the U.S. Really, I'd call it North American industrial base, and it's happening now. It's very rapidly. If you look at like drivers of GDP growth the last few quarters, it's been non-residential construction. So that's what a lot of this is, and so it is happening. It's happening right now, and part of the reason why oil prices have been firm. And again, the U.S., we're never going to be energy independent. The global markets, like, it just doesn't work that way. But we can produce what we need, and certainly within North America. So it does mean geopolitically, the U.S. is not as committed to necessarily responding to everything in the Middle East or something like that. But I would expect that you may get more drilling opportunities in the U.S. under Trump versus Biden. So at the margin, maybe you could have lower oil prices. Certainly, you get more investment, and so companies that really focus on investment exploration, they could be beneficiaries from a Trump administration versus a Biden administration.
Okay, so the next question may actually help with the debt levels and the interest payments on load on the budget. How will the election result affect monetary policies, and do you think it will determine the timing of any Fed action?
So the Fed's independent, and I think, for the most part, they will act independently. Now, the Fed is working right now towards lowering interest rates. And there's some debate over whether or not they should do it, because is inflation's kind of stuck around 3. The Fed said it doesn't have to get to 2, and making progress to 2, and that progress is stalled. I don't think they want to start an easing cycle right before the election, and so that may, at the margin, come into a decision. Cut right now, they're kind of preparing the market for a June cut. They could even maybe push it off to July. After July, I think it could be tough, not only because of the election, but also some of the things that are helping bring inflation down right now, like housing. We know housing prices have gone up, and there's a lag between the housing prices and when they impact the CPI. So we know we're trying to get the fourth quarter, like that component of CPI, and also core PCE, the Fed's target, it's going to start to move up. Same thing, some supply chains, we're still kind of benefiting year over year from better supply chains. By the time we get to the end of this year, that's going to be over with. And so that's probably the bigger issue for the Fed. But yeah, I don't think they want to get into that. They'd like to go ahead and start on if they're going to do an easing policy, they'd like to start it sooner rather than later. I think the bigger thing is something we talked about earlier, and that's the deficits. If there's more deficit spending, that probably means tighter monetary policy, which becomes tougher because that means higher interest rates, which means the Fed's got to pay more on debt. So that becomes an issue. But that the deficit spending is inflationary, and the Fed's going to have to respond to that. And that's something Powell has mentioned in the last last year when people asked about the big deficit spending, he said, "Well, that's not my job to determine, but it's our job to react to it." And so I think that would happen. But yeah, I think overall, I am kind of in the camp of the Fed. It's gonna be as independent as they can, but trying to maintain their independence, they may try to sidestep being in the limelight right before the election.
Okay. It's tax season, everyone's favorite bedtime story. Are there important tax policy differences of each candidate we should be aware of?
So there are. So the domestic economic policies are quite different, but I don't think it's going to matter a whole lot because they're both going to be dealing with a very close Congress. And so in tax policy is something driven by Congress. So say tariffs, the president can put them on. That's why one of the reasons why Trump really has liked to use tariffs is because he could just he could go and implement the policies he thought he should without having to battle with Congress. But when it comes to taxes, you do have to get stuff through. Trump has thrown out, I think a 15% corporate tax rate. That I think would be tough. And Biden has thrown out, a few different tax increases, including the buyback tax, and reversing some more of the Trump tax cuts from before. And also there are some from the Trump tax cuts, some of those expire, so that we have to deal with all those. But usually what happens is those expired tax cuts get extended because nobody wants to have that blood on their hands. But so I think proposals will be very different unless somebody wins in a landslide or close to a landslide and really has Congress in their corner. I don't expect there to be a major change in tax policy.
Okay. I run out of my questions, Ed. We expected a short meeting this evening. Here are my takeaways, and let me know what you think about these. One, after that clean energy chart that you have shared, never take any piece of information for granted. There's no brainer. I remember people buying clean energy stocks anticipating Biden administration. There's no easy answer in the market, but the other chart you shared where stock market performance, first, second, third, fourth year of election cycle, we can be cautiously bullish about, there you go, the bullish about the next 12 months, so to speak. Now, like you said, maybe small caps do better and cyclicals. And my third is, since expectation at least is a close election, sometimes split power is when markets do better, especially the Democratic presidents with Congress. So I'm barring a really catastrophic blood on the street scenario, I am leaving this evening cautiously optimistic or bullish. What are your thoughts?
I think that's our conclusion as well. Yeah, I agree with you. And when we put this together, Rob Anderson, our sector strategist, put together this chart on the energy sector. That was such a wow moment, especially just how exactly when the peak was. I mean, if there's ever a buy in the room or sell in the news event, it was Biden and clean energy. And so I have to know, where you are, where the sentiment is. That's why we look at sentiment a lot at NDR, most, and we didn't get, we're talking about the elections here, so we didn't getting into all of our other stuff, but most of our other indicators are bullish right now. Economic projections look pretty solid, recession risk low. earnings growth looks to be pretty solid. The technicals actually look very strong. Don't listen to everybody who says this is a narrow market because of the Mag 7. That's actually not the case. It's actually pretty broad advance. But so a lot of things are lining up for the bull market to continue. And so that would, again, be roughly in line with what you'd expect. But I also don't want to forget about the tendency for the market to have a pullback right before the election. And so, again, with the uncertainty, it's probably going to be a close election, and there's a lot of uncertainty. Probably, the mud is going to be slinging. So just don't be surprised if that something like that comes up this summer into fall, especially since we really we didn't get that pullback earlier. That the market's vulnerable to anything that could come along that could trip it up, and if it happens to be election uncertainty, then maybe that could be the thing.
Well, especially when you're all-time high in many major indices, and that could be vulnerable to that type of a pullback. No one would be surprised, I think, at least like people like us who follow NDR. Okay, we ran out of our questions. Is there anything you want to add, Ed, before we close this evening?
I think we covered it. I just, I think the one thing I'd say is, look, I have my political views. Hopefully you don't know what they are. Hopefully they didn't come out. We all have our views. But the market's rallied under all sorts of conditions, so let's not, don't let our own political views get away with opportunities to make money in the market and for our clients.
I think that's one sentence we should these days print and put on the wall. I've seen during Obama years Republican investors losing out. I've seen Democratic investors losing out in Trump years. You guys, I remember years ago, I've been following you guys for 17 years. I remember Ned Davis is actually one of the lines, and it really opened my mind. He said, "My job isn't to be right. My job is to make money for my clients." Something like to that effect. So our job is to basically look at data and hopefully make better decisions more often than not without being captured by our political biases. So thank you so much for your time. I know you're on the East Coast. It's 8:30 approaching 9 for you, Ed. I appreciate that, taking away time from your family. Folks, it's all for this evening. I hope you found this informative and useful. Please reach out to us if you have further questions. We'll follow up. We can forward those to Ed, or we can try to answer based on our abilities.